behalf of Team 1 from the University of Minnesota, we welcome you today as we initiate a buy recommendation of Sun Country Airlines with a 1-year target price of $22, a 34% upside from its most recent closing price. Our recommendation is based on the following 3 catalysts. 1. As the firm continues its exclusive deal with Amazon Air through 2025, we expect to see already industry-leading margins enhanced. 2. With the company's transition to an asset-light operating model, we expect to see shareholder value increase through asset efficiency and lower capital expenditures. And 3. With a strong balance sheet, we expect that Sun Country will be less risky than its highly cyclical peers. I will now pass things on to Jack to discuss the company and its industry.
Sun Country is an ultra-low-cost carrier, or ULCC, based out of Minneapolis, Minnesota. They have 5 key revenue segments, which are scheduled services, ancillary, charter, cargo, and other. Finally, they operate 116 routes, serving 104 markets, and mainly fly domestic. Now, what makes this company really stand out is their variable capacity model. By diversifying their revenue, they are protected from fluctuations in scheduled passenger demand. Also, their fleet standardization allows them to have easy transition between pilots and also reduces the risk of production delays. Overall, this economic moat is very hard to duplicate. Now, the most exciting revenue segment is cargo due to their exclusive partnership with Amazon as a sole narrow-body operator. Now, this deal has just been revised to include a fleet expansion and also performance-based incentives, where Sun Country will issue stock awards based on cargo volume. Now, looking at the industry analysis, the ULCC and LCC market has grown rapidly. The ULCC had nearly doubled in market share, and LCCs now control over 30% of U.S. airline capacity. However, this growth has came with challenges. The post-pandemic travel boom has seen rapid expansion, but flight demand has put pressure on the ULCCs, especially those focused on high utilization. The 2 largest ones is competition. It says the 2 largest ones is competition and supplier power. In terms of competition, there are saturated routes and price wars that are driving down these fares. On the supplier side, Boeing and Airbus have a duopoly. However, Sun Country is well protected due to their fleet of mostly used planes. Now I'll pass it to Sam to give you the financial analysis.
Thanks, Jack. Well, we saw margins slide across the industry as overcapacity hit everyone. However, Sun Country was able to maintain its no-pat margin dominance and actually even expand the gap between it and its peers' return on invested capital. So how does overcapacity affect Sun Country? Sun Country grew its capacity faster than the industry growth rate. This led to a slight drop in their load factor, how full the planes were, which in turn led to a slight drop in passenger revenue as average base fares fell and revenue per available seat mile. However, Sun Country was insulated through its cargo and charter revenue segments, both of which grew in revenue year over year despite a decrease in capacity. Now on to cost. The 2 biggest costs for Sun Country and airlines alike are aircraft fuel and wages. Sun Country is a leader in aircraft fuel efficiency thanks to cargo and charter jet fuel pass-through costs. They are significantly below the peer median and even more so below ULCC peers, and we expect this expense to revenue to decrease over time, as shown by a decrease in crack spread and future prices of crude oil. Now, a big expense on a lot of aircraft lines is wages. Pilot demand is currently outpacing supply, and this is forecasted to continue. However, Sun Country remains below the peer median, but we expect this expense to affect all airlines going forward. Now, Sun Country saw an improvement in their leverage position year over year, and now they nearly lead the peer group in total debt and leases to equity. Sun Country is well within all of their debt covenants, and they've seen their operating margin grow proportionally more than their interest expense. Additionally, their liquidity position is significant in comparison to their debt principal repayment schedule. Now on to the catalyst. We believe that Sun Country's no-pat margin will continue to grow, and they will maintain the gap between it and its peers' return on invested capital in a low growth rate environment. This will be done through its variable capacity model. As in 2025, Sun Country plans to increase cargo capacity by 65% with continued growth onward. This should improve cargo's revenue per block hour as rates and volume both improve, leading to an uplift in cargo's margin as fixed costs scale down in proportion to revenue. Now, what this allows is it actually allows passenger capacity to decrease, allowing passenger flights to prioritize profitability overutilization. This should lead to an overall improvement in total operating margin, as cargo will allow passenger to focus on that profitability over utilization. Now, onto our second catalyst. Sun Country has an asset-light business model as they lease a good amount of their fleet, and they are providing those third-party aircraft from Amazon. This has led to their invested capital returns being slightly higher than the peer median, but they have a big point coming up here, where they're getting 5 aircraft back that are currently leased out to other airlines, along with 8 freighters from Amazon. Now, management doesn't expect any aircraft-related capital expenditures until 2027. By keeping their invested capital base very similar, this should boost invested capital returns, which, paired with growing NOPAT margins, should lead to the gap between Sun Country and its peers' return on invested capital increasing. Finally, the airline industry is very levered, and bankruptcies like Spirit are on everybody's mind. However, the way the Amazon deal is set up, Sun Country issues performance-based warrants to Amazon based on cargo volume. This maxes out at a 15% equity position from Amazon, which we forecast to be hit. This gives Sun Country a significant opportunity to deleverage while aligning partner incentives. That, paired with our growing positive free cash flows and improving coverage ratios, makes Sun Country a financially sound investment compared to its more volatile and leveraged peers. I'll pass it off to Sam for evaluation.
Thank you, Santi. Now, moving on to valuation, our team used a 50-50 split between relative and DCF methodologies in order to arrive at a target price of $22 with an upside of 34%. Now, our DCF valuation suggests Sun Country is worth $23 with an upside of 39%. We calculated this with a 9% short-term sales growth rate, which we backed into a 2.5% terminal sales growth rate. Our WACC was 9.1%. We also performed a sensitivity analysis on our DCF by shocking revenue, cost, and CapEx. As you can see in our projections, our bear scenario was $20 and our bull scenario was $26. We further supported this with a 5,000 iteration Monte Carlo analysis, which strengthens our bias position. Now, moving on to our relative valuation, this suggests Sun Country is worth $20 and with an 18% upside potential. Now, we decided to use an EV to EBITDA multiple, as this allows us to remain agnostic as to whether airlines are using leasing their airlines or owning their airplanes. And I would now like to hand it off to Kaya to discuss how ESG has impacted Sun Country.
Thank you, Sam. Sun Country has the lowest environmental risk in its peer group, although management responsiveness to ESG challenges remains an area for growth. Despite this, the company is a leader in ULCC fuel efficiency, decreasing emissions by over 20% since 2019, reinforcing its commitment to sustainability efforts. The company is a leader in community engagement, reinvesting a higher percentage of revenue than peers into local partnerships, driving home brand equity and trust. With union participation high, female leadership nearly doubled since 2020, and a representative board, Sun Country truly represents its dedication to retention and diversity. Governance is a strength, with an independent board with strong oversight and fair compensation, enhancing its commitment to shareholder value alignment. I will now pass things back up to Sam to discuss risks.
Thank you, Kyle. There are 7 key risks, 4 of which are more pressing than others. First is economic condition. We anticipate this to be volatile. However, given Sun Country's variable capacity model, they can easily switch between demand segments, whether that's passenger, cargo, or charter, depending on which is most profitable at the moment. Next, we have regulation. The airline industry is very sensitive to regulation. However, given the newly inaugurated administration, we anticipate this to decline. Next is fuel prices. These make up 24% of Sun Country's operating expenses. However, given the pass-through in both charter and cargo, this is less of a risk. Additionally, in the past, they have hedged against their passenger fuel. And lastly, we believe this to be the most impactful risk for airlines, which is pilot labor environment. However, Sun Country does a wonderful job of mitigating this risk due to 3 factors. 1 is work-life balance, 2 is career flexibility, and 3 is compensation. Now, in short, while risks do exist, we believe Sun Country is strategically positioned to present investors with a valuable investment opportunity. Therefore, we would like to reiterate our $22 price target and a buy recommendation, one which we believe will help investors soar to new heights. Thank you, and we would be happy to take your questions at this time.
you're on the sell side, and I'm calling you back. Okay, now it's not. Okay, you're on the sell side, and I'm calling you. You know who I am, and I work for a hedge fund, so you don't know if I want to go long or short, so I'm calling position currently. So what are the bears saying? What are their concerns?
Bears, to find the,
The people who are short sellers, who are not thinking the price target is where it should be.
yeah, well, I think that's, it would be, I feel like people are misvaluing, Sun Country drastically. I think that there's many things that the market is not getting right now. And a big part of that is, I think Sun Country is being sort of lumped in with other ULCCs. And so they're not quite understanding the difference in business strategy or the variable capacity model, which allows them to remain resilient in times of recession. One example of this was just recently COVID. You can see all the other ULCCs suffered greatly, whereas our cargo segment actually, revenue increased greatly and allowed us to sort of stay above the curve there.
Yeah, can I just add on really quick what he's saying? Adding on to what Sam said, yeah, when there aren't very many public ULCCs within the United States, so when people think ULCCs, they think a lot of times they think Spirit and Frontier, both of which you mentioned grow through minimizing fixed costs through scaling, like rapidly, which was very much enabled after COVID. However, Sun Country is more focused on profitability than utilization with these other revenue segments. So from the outside, when you just hear ULCCs, a lot of times people think of those more growing capacity focused tiers.
Just lastly, you mentioned that there were aircraft coming back to them. What does that mean financially, and what does it mean to their capital structure?
What it means is currently they're generating other revenue on those planes. They're leasing them out. Yeah, exactly. They're coming back from Oman Air and Fly Dubai, meaning that they're not going to have to take out any new leases, which is why one of our theses is their invested capital base will stay lower. They won't have to have any additional aircraft capital expenditures until 2027. So basically, they just have all these aircraft coming back, adding on to potential passenger capacity expansion.
And I'd like to add on there, one thing that really differentiates Sun Country here is that all these other ULCCs, they are very susceptible to supply demand, and right now getting an airplane is very difficult to do with Boeing and on the other Airbus. And so Sun Country, they actually don't need to purchase any airplane within the next 2 or 3 years because of these airplanes that are coming back. So they can grow without capital expenditures, which other airlines are not going to be able to, easily purchase new airplanes because of this backlog.
Yeah, they're not dependent on order books.
So, if you decompose your forecast, is this entirely a bet on Amazon growing the business? And I wasn't clear on, the passenger and charter side. Is that supposed to grow without adding airplanes? And if so, how do you do that?
Well, we have, so as we mentioned, the industry growth rate for available seat miles is declining right now. And they're cutting passenger capacity, so they don't need to add on new passenger planes right away. Some of our thesis is dependent on Amazon growing their cargo business, but we didn't forecast it out of reason or within line with how many planes are expected, Amazon is expected to provide to them. Did that clarify?
I could just maybe follow on that a little bit. Does that mean in 2 years that the non-freight side has not grown and it's all the growth incrementally is Amazon? Is that how the model works for you?
Well, so I think passenger growth is expected to return once this short-term cargo growth sort of takes advantage. So these 80 Amazon planes will come into effect, and once that's done, then Sun Country plans to focus back onto their passenger growth with these planes that are returning from Oman Air and Dubai.
Cargo just allows passengers to be more profitable. Basically, margin improvements happening in passengers because they're planes on more goals, and they're going to be able to focus on those profitable routes still. It is nice to have cargo margins improve, to rely on a little bit more to take back passenger capacity, but it's equally reliant on both.
Great job, guys. You guys touched upon not only the fuel costs, but also the wage costs for Sun Country. You mentioned about the work-life balance for their employees. Just curious, what kind of benefits? Typically, my understanding is they have a pretty sizable pension liability. Just curious if you have also looked into that on an ongoing basis for the wage, all the costs for, I guess, wages.
How we forecasted it going
Yeah.
forward. Well, I can talk about more detail now. We have wages as a percentage of cargo revenue are more than passenger, so that's why the gap between them and peers is decreasing a bit until passenger grows more in the future. But what Sun Country's advantage is that Minneapolis hub. So we actually talked to a pilot, and he gets a variety of flying, so he can switch between scheduled service, charter, and cargo. But he also has the ability to fly out of Minneapolis and back to Minneapolis the same day and see his wife and the kids. So it's like, and a lot of people tend to stay in the Midwest sometimes, you know what I mean? So it's like, isn't that flexibility?
And just to add on that, so like Palace Delta, for example, a lot of times they're flying, a week at a time, and they don't have the opportunity for this work-life balance that Sun Country allows.
Okay, that's good. And another question, if you look at the ownership of the stock so far, what's your kind of take on the current composition on the institutional ownership of the stock? Maybe more comment more on the private equity owner.
Right further Apollo.
Yeah.
Yeah, so they recently they liquidated their shares to look at more analysts. This is just a movement in terms of their investments. I wouldn't say this much effect on the Sun Country, but this is just a investment decision on Apollo's part.
They just need liquidity to buy for.
If you're a competitor to Sun Country, you might look at their passenger business and say, they're, in a way, they're subscale with the airlines that they've got, the routes they've got. Historically, this happens a lot in the airplane business, in the airline business. You go after those competitive routes, and you'll sacrifice profit, and you know that the customer only looks at price. Why wouldn't this company come under attack on their sweetest routes because they're vulnerable in that respect?
Well, only 2% of the routes are consistent and year-round. It really comes back to that flexibility. It's not that they couldn't have route competition, but already how it is at the Minneapolis hub, they're like very proportional with Delta. They aren't stepping on each other's toes too much on routes, and they have that flexibility to switch it up. So if one route got overly saturated, it's not too hard for them to change their route structure. And then you want to add on.
Yeah, I'd just like to add on to that. So one thing that they can do that other airlines can't do is fly, maybe twice a week, but just 2 days out of the week. And they can fly these maybe high demand routes, maybe just like Labor Day weekend to Cincinnati or something. And there's people that need to fly these routes, but other airlines are not offering it because they can't profitably do it by flying every single day a week. And so what Sun Country can do is fly 2 days that week to Cincinnati, take advantage of that demand, and then go and take that somewhere else.
As they said, they might not choose to fly on that Tuesday in September.
So it seems like a lot of the thesis is this margin mix shift improvement from scheduled service to cargo as they expand that business with Amazon. Amazon, historically not a company that loves other parts of the supply chain to be making money. So just curious if you thought about risks to that margin thesis as they grow that side of the business.
I mean, one thing about the Amazon deal we talked about, it is a mutually beneficial agreement between both of them, especially with that performance incentive, where they're issuing stock warrants, so they both can kind of go together. So in terms of that deal, it's beneficial for them to both increase that volume. Also on Sun Country's side, it lowers their costs because of their control the planes to really efficient.
And then just add on that, one thing that provides a really great advantage over the other airlines is, I include the